Is the crypto bull run dead? After months of hype around Bitcoin's halving and institutional adoption, altcoins are still struggling and the market feels stagnant. In previous cycles, Bitcoin led the charge, followed by an explosive alt season, but this time things are different. Bitcoin is dominating, Ethereum's ETF launch was underwhelming, and macro conditions are holding back liquidity. So, is this just a delayed altcoin rally, or has the 4-year cycle been completely broken? Welcome to the Chainpoint channel. In this video, we'll break down the truth behind this market cycle, including why altcoins are lagging, how institutional investors are shifting the game, and what catalysts could spark the next rally. If you're holding crypto, this is a must-watch, because if you're waiting for a traditional altcoin season, you might be in for a surprise. But before we continue our talk, don't forget to hit the subscribe button to stay tuned to what is happening in the crypto world. And remember, everything we say here is not investment advice. Always invest wisely. Let's get started. The crypto market has long been defined by a 4-year cycle, a pattern that has repeated itself since Bitcoin's inception. Historically, this cycle consists of a 1-2-year explosive bull run, followed by a 2 to 3 years bear market where prices cool off. Each cycle has been driven by a mix of Bitcoin halvings, macroeconomic conditions, and shifts in investor sentiment. While past cycles have shown clear boom and bust trends, many are now questioning if this predictable rhythm still holds. Are we in a new era of market dynamics, or is history about to repeat itself once again? Bitcoin has been the centerpiece of every cycle, setting the tone for the entire crypto space. After each major rally, capital typically flows into altcoins, creating the infamous altcoin season, where speculative assets experience exponential gains. However, in the current cycle, Bitcoin's dominance has remained unusually high, with many altcoins struggling to gain momentum. This divergence has led to speculation that Bitcoin is no longer as correlated with the rest of the market as it once was. Could this mean that the traditional crypto market structure is changing? One major factor shaping this cycle is institutional involvement, which has increased significantly since the last bull run. The approval of spot Bitcoin ETFs in early 2024 brought in billions from Wall Street, shifting market dynamics away from retail-driven speculation. Despite this, the long-anticipated Ethereum ETFs have seen underwhelming demand, raising questions about whether institutions are truly interested in altcoins. With stricter regulations and evolving investment strategies, institutions are reshaping the market in ways that differ from past cycles. Another key difference in this cycle is macro influences, which have become stronger than ever before. Investors are keeping a close eye on global liquidity trends, political shifts like the Trump administration's stance on crypto, and how government bonds compete with digital assets. Historically, a flood of liquidity has preceded every major bull run, but this time, tight financial conditions have slowed market momentum. Every 4 years, the Bitcoin halving slashes the block reward for miners in half, effectively reducing the rate at which new BTC enters circulation. This built-in scarcity mechanism has historically been a major catalyst for Bitcoin's price appreciation, as demand outpaces supply. The 2024 halving was no exception, fueling speculation of a new bull run. However, unlike previous cycles, macroeconomic liquidity conditions are playing a bigger role than ever before. This raises the question, is the halving still the main driver of Bitcoin's price? Well, while Bitcoin's supply dynamics are predictable, global liquidity cycles are much harder to time. Traditionally, market liquidity follows a boom-bust pattern, influenced by factors like central bank policies, debt refinancing, and interest rates. When liquidity is abundant, investors take on more risk, driving up crypto prices. However, when liquidity tightens, like we've seen in 2024, capital flows into safer assets like US government bonds instead of crypto. This delayed liquidity effect may explain why Bitcoin's post-halving rally has been slower than expected. Another major shift is the increasing role of institutional money, which behaves differently from retail investors. Unlike in previous cycles where Bitcoin saw immediate parabolic moves post-halving, institutions are more calculated, waiting for confirmation before deploying large capital. This is evident in the underwhelming inflows into Ethereum ETFs, which suggests that big money isn't rushing in just yet. If liquidity conditions improve in late 2025, as some analysts predict, we could see a delayed but powerful rally across the market. So, does Bitcoin still follow its halving-driven cycle, or is liquidity now the dominant force? Historically, altcoins explode 12 to 18 months after the halving, meaning a true alt season might not arrive until mid to late 2025. However, if liquidity remains constrained, this cycle could play out much differently than before. Unlike previous bull runs where altcoins surged alongside Bitcoin, this cycle has been completely different. Bitcoin has dominated the market, reaching new highs, while most altcoins remain stuck in sideways price action. This divergence has led to heated debates about whether Bitcoin is decoupling from the rest of the crypto market. Historically, Bitcoin's dominance fades as risk appetite increases, but this time, institutions seem far more interested in BTC than in speculative altcoins. Could this be the end of the traditional altcoin cycle as we know it? One key factor behind this shift is institutional preference for Bitcoin. Unlike retail traders who chase high-risk, high-reward altcoins, institutions favor liquid, regulated assets, and Bitcoin fits the bill. The launch of spot Bitcoin ETFs in 2024 funneled billions into BTC, while Ethereum ETF saw far less enthusiasm. Meanwhile, altcoins face additional regulatory scrutiny, making them less attractive to big players. As a result, many altcoins have failed to reclaim previous highs, leaving investors wondering if their time will ever come. Another reason for Bitcoin's outperformance is the changing market structure. Stricter KYC regulations on centralized exchanges have pushed traders towards non-KYC decentralized platforms, limiting the easy fiat on-ramps that fueled past altcoin booms. Additionally, the crypto market is now more macro-driven, with investors prioritizing liquidity and stability over speculative bets. If risk appetite remains low, many altcoins could struggle for much longer than in previous cycles. But what happens if liquidity returns? Historically, altcoin rallies tend to happen 12 18 months after the Bitcoin halving, meaning that if history repeats itself, altcoins could take off by mid to late 2025. However, with institutions shaping this market more than ever before, it's possible that only a handful of altcoins, those with strong narratives and real adoption, will see significant gains. Institutions have completely reshaped the crypto market, shifting the way capital flows into Bitcoin, Ethereum, and beyond. In past cycles, retail speculation drove parabolic altcoin rallies, but this time the focus is on regulation, compliance, and structured investment products. The approval of spot Bitcoin ETFs marked a turning point, attracting billions from institutional investors. However, the anticipated Ethereum ETF launch in 2024 saw disappointing inflows, raising doubts about whether institutions are truly interested in altcoins. Could this mean that institutions will dominate crypto's future, leaving retail traders behind? A key challenge for altcoins is regulatory uncertainty, especially in the US, where securities laws remain unclear. While Bitcoin enjoys regulatory clarity as a commodity, many altcoins are still at risk of being classified as securities by the SEC. This makes institutions hesitant to allocate capital to anything beyond BTC and ETH. At the same time, stricter KYC rules on centralized exchanges have made it harder for retail traders to speculate, further limiting altcoin momentum. With these shifts in market structure, only a select few altcoins may survive the long-term institutional wave. Another major factor is macro liquidity. Institutional investors don't just throw money into crypto whenever prices drop, they wait for favorable liquidity conditions. Currently, risk sentiment remains low, with many funds prioritizing US government bonds over crypto assets. Historically, altcoins thrive in high liquidity environments, but with liquidity still tight, institutional money is staying on the sidelines. If global liquidity trends shift by 2025, we could see a delayed but significant institutional entry into altcoins. So what's next for institutional adoption? Some experts believe the real catalyst will come from major banks and governments holding Bitcoin as a reserve asset, or Ethereum-based tokenization of real-world assets. If institutions continue favoring Bitcoin over altcoins, the traditional 4-year crypto cycle could look very different this time around. Right now, the crypto market is battling against macroeconomic headwinds, with investors becoming more risk-averse than ever. In previous bull cycles, abundant liquidity and retail FOMO fueled wild price swings, but in 2024, institutional caution is keeping the market in check. One major factor is the uncertainty surrounding the Trump administration's policies on crypto regulation and monetary policy. While Trump has signaled a more pro-crypto stance, institutions are waiting for regulatory clarity before making big moves. This hesitation is causing capital to flow into safer assets rather than altcoins. One of the biggest challenges for crypto right now is the competition with US government bonds. As bond yields have dropped, institutional investors are parking capital in low-risk assets rather than allocating it to speculative markets like crypto. This shift in capital flows explains why Bitcoin has held up better than altcoins, as BTC is increasingly viewed as digital gold rather than a speculative asset. However, for a full-blown crypto bull run to return, liquidity needs to increase and risk appetite must improve. The question is, when will that happen? Historically, global liquidity cycles drive market booms and busts, and crypto has followed this pattern closely. When central banks inject liquidity into the system, risk assets, including Bitcoin and altcoins, tend to surge. However, liquidity has remained tight in 2024, slowing down crypto's recovery. Some analysts predict a major liquidity injection by late 2025, which could unleash the next wave of capital inflows into crypto. But if macro conditions remain tight, altcoins could struggle much longer than expected. Despite these macro challenges, some catalysts could shift sentiment quickly. If central banks pause rate hikes or crypto-friendly regulations take shape, institutional capital could pour back into the market. Additionally, a weakening US dollar or a global shift toward Bitcoin as a reserve asset could fuel the next rally. Until then, crypto remains in a tug-of-war between risk appetite and macro uncertainty, leaving investors asking, will altcoins ever catch up, or is Bitcoin the only safe bet in this new era? Every crypto bull run has been fueled by a major catalyst, whether it was Bitcoin's halving, institutional adoption, or a surge in retail FOMO. But what could trigger the next rally? One of the most anticipated shifts is central banks adding Bitcoin to their reserves, a move that would legitimize BTC as a global store of value. Countries facing high inflation or economic instability could be the first to adopt Bitcoin as a hedge against fiat devaluation. If this happens, it could set off a domino effect, driving Bitcoin's price higher and reigniting interest in crypto as a whole. Another major development is Ethereum-based asset tokenization, which is gaining traction among traditional financial institutions. The idea is simple. Real-world assets like real estate, stocks, and commodities could be represented as blockchain-based tokens, making them more liquid and accessible. This could bring trillions of dollars into the crypto space, with Ethereum and other smart contract platforms leading the charge. Companies like BlackRock and JP Morgan are already experimenting with tokenized finance, signaling that mainstream adoption is closer than most people think. Regulation is also playing a critical role in shaping the next bull run. While unclear regulations have slowed institutional adoption, a clear legal framework could be the turning point. The Trump administration has hinted at a more crypto-friendly stance, and if this translates into regulatory clarity, it could unlock a wave of institutional inflows. Additionally, approval of spot altcoin ETFs such as Solana or XRP could provide new on-ramps for institutional money, making the market more structured and accessible. Finally, technological advancements and adoption trends will be key drivers. Payment giants like PayPal integrating stablecoins on Solana, the rise of Layer 2 scaling solutions, and new DeFi innovations could all push crypto into the mainstream. Historically, altcoin season arrives in the final phase of the 4-year crypto cycle, when Bitcoin reaches its peak and investors rotate capital into higher risk assets. But this cycle has been different. Bitcoin has dominated while most altcoins remain stagnant. Many traders are now wondering, will altcoins ever take off, or is this cycle broken? If history holds true, the true altcoin rally could still be ahead, likely unfolding 12 to 18 months after the 2024 halving, meaning a mid to late 2025 breakout. The big question is, will this be another explosive alt season or just a selective rally for the strongest projects? One reason altcoins have struggled is institutional control over market flows. Unlike retail-driven bull runs of the past where altcoins pumped purely on speculation, institutions are allocating capital carefully. Ethereum has underperformed despite its ETF approval, and smaller altcoins are still waiting for a liquidity surge. If altcoin season does return, it will likely be different from previous cycles, with strong narratives, real-world adoption, and institutional backing playing a much bigger role. Could this mean only a handful of altcoins will truly take off? Another factor is macro liquidity conditions, which have historically lagged behind Bitcoin's price action. In previous cycles, altcoins pumped months after Bitcoin peaked as investors looked for higher returns. Right now, liquidity remains tight, with many funds prioritizing low-risk assets like bonds. However, analysts predict that global liquidity could rise significantly by late 2025, aligning with a potential final altcoin explosion. If that happens, we could see a repeat of 2017 or 2021, where altcoins outperform Bitcoin in the last leg of the bull market. The real wild card is narrative-driven hype. Meme coins, AI-based tokens, Layer 2 solutions, and real-world asset tokenization could be the key sectors that attract retail and institutional money. But with market conditions shifting, not all altcoins will survive. Only those with strong fundamentals, real adoption, and liquidity backing will thrive. So, is the crypto bull run really dead, or is this just the calm before the storm? History suggests that altcoin season happens in the final phase of the 4-year cycle, but this time institutions are in control, macro conditions are tight, and liquidity is moving differently. If Bitcoin keeps dominating, will altcoins ever catch up? Or are we entering a new era where only the strongest projects survive? What do you think? Will we see a massive altcoin rally in late 2025, or is this cycle completely different? Drop a comment below with your thoughts, and if you found this breakdown valuable, smash that like button and subscribe for more deep dive crypto insights every week. Thanks for watching this, and I will see you in the next video.